Good morning, guys. How you doing? This is Ryan. Welcome back to the channel. Just finishing up a morning run, and I wanted to answer a question I get all the time, a very popular topic about real estate in South Florida. Is should I wait for the market to fall, or should I wait for the market to crash even before I buy my next house? Let's talk about that. Now, before I discuss this topic, sorry, for some reason this morning I have to keep on cleaning off the lens. For whatever reason, the lens is getting foggy, so bear with me if any parts of this video the lens kind of fogs up. I'll do my best to keep it nice and clean. So should I wait for the market to crash before buying my next house? I'm very empathetic to this question because in 2008 we saw housing prices here in South Florida grossly misvalued. They were even more expensive in 2008 than they are today. And that's 11 years ago. Now, one thing we have to understand is back then the lending standards were very, very low. Literally, proof of income was nothing, and one can still be critical that today lending standards are still very low. And what I mean by that is what we just saw in this past year. We saw interest rates go up, 30-year fixed rate mortgages were over 5%, and the market cooled in a lot of places. We saw housing prices drop about 10% in a lot of markets. So the reaction to that was softening of interest rates. So now housing prices can go back up. And the reason that makes me empathetic is because the economy is a very political thing. This channel is not political, but we have to understand the politics. We have to understand that in a pure free market economy that recessions are necessary. Recessions happen. The reason they happen is because capitalism wants to get rid of bad debt and have it replaced by stronger and wiser debt. It's a competitive system that's always trying to strengthen itself. So there has to be losers, and smarter and wiser people need to come in and build the economy on top. So people fail, people learn from those mistakes, trial and error. That's the way the system works. It's not a very politically favorable thing to say is during this election cycle, we may have a recession because the market is cyclical, because the business cycle is cyclical. You'll never hear a president say that. You'll hear the president want to get elected because I'm a great jobs creator and all this, but when in fact, it's not really the president's job to be a job creator. The business cycle is a more organic thing than that. Not one person can really have power over that. But one thing that we do have is a Federal Reserve Bank. The Federal Reserve they kind of seem to act in a way to protect the economy from ever going down. Well, the Federal Reserve's objectives are: one, price stability, which was I think their initial goal, but now they are involved in stimulating economic growth as well. So whenever the economy slows down a little bit, they'll make capital more accessible. They will lower interest rates. And think about interest rates. Interest rates is the cost of borrowing money. It's one of the very few things in our economy that's actually price fixed. In Soviet Russia, they used to price fix all kinds of commodities. For example, bread. They would price fix the cost of bread. They didn't allow the free market to do it, and they didn't allow supply and demand to work. So what you had was either too little or too much made, depending on the price. If something is made too cheap, it's gonna be overly used. And if it's too expensive, nobody's gonna buy it. So when you have interest rates suppressed for a long time at a low rate, you're gonna have more people that are going to borrow. And that kind of borrowing is gonna cause anything that you have to borrow money to go up in price, so like a mortgage. So this kind of prolonged state of suppressed low interest rates can cause there to possibly be an overvaluation in real estate. So that's my first disclaimer, is that I'm empathetic that today's real estate prices could be overvalued. And certainly if interest rates were much, much higher, we would see housing prices go much, much lower. People really buy houses on the monthly payment comparative to a rental payment. The 30-year fixed rate mortgage is just under 4% right now. If that number were to double, housing prices would drop drastically in price. But what would cause housing prices to go up drastically in price? It would honestly have to be a rise in inflation, which right now, again, we've talked about before, is anywhere between 2 to 3%. And the Federal Reserve believes that's a moderate number, so they feel okay with keeping numbers low. But if inflation for some reason were to take off, you would see rates rise and asset prices plummet. So with that disclaimer, that's the one side of my head that says, you know, what is the downside risk of buying real estate? That I do think long-term suppressed interest rates could be making them an overvalued asset in today's market. So should we not buy a house? Well, my answer is that you need to buy the right kind of house. And let me answer that. We understand that housing prices could possibly be overvalued in the short term. In the long term, they're likely to go up and up in price because that's what past trends have taught us. And the way you buy a house has to be strategic. So I've purchased 2 properties now, and both of them I've purchased them about 10% below their current market value. So I've patted myself in 10%. If the market were to pull back shortly after my purchase, I still wouldn't have really lost any equity. So that's step number one. Only buy houses under market value to protect yourself from the market pulling back. Two, or I actually should say before that, is realize that 2008 was like the perfect storm. And the economy really hasn't seen anything that drastic since 1929. So we have to put it in perspective that that's probably, or hopefully, a once-in-a-lifetime storm that we had to go through. And we will see more recessions, and we will see drastic price movements, but hopefully nothing that drastic. Okay, so getting back. So we buy the house underneath the market value. That's the first thing you need to do. Don't pay current market value. It's just like buying any investment. You want to buy it with instant equity. You want to buy it undervalued. So for example, I saw the stock market a few weeks ago with the trade war. We had stocks like Alibaba going down, Tesla was getting beaten up, a lot of things were getting oversold, and it appeared that those stocks were undervalued, and I think Tesla's jumped back like 30% already in a few weeks. So same things with a house as an asset, buy it under market value. There's also something I do truly believe. I don't believe the house you live in is an asset. It's a potential asset. I think it's actually more of a liability because it's costing you money. It could appreciate in value. And then the other reason why you should not wait for the market to crash before buying your next property is buy a property that cash flows. So I would say it's okay with buying a house in today's market if one, I'm buying it underneath market value, and two, it cash flows. So what that means is, could I rent it out at a profit? And you have to understand, during a recession or during a market pullback, the renter pool actually increases. Rents will probably stay stable during that time because you have a lot of people that now cannot afford to buy houses, now must rent. The renter pool grows exponentially. So to recap, yes, housing prices could be overvalued in the short term because of suppressed interest rates. I do believe it's very possible. But you still could buy a house, but you have to buy it smart. You have to buy it under market value. And ways to do that is you have to negotiate a deal. I'll make future videos about how to negotiate real estate to get yourself the best possible deal. And then also buy property that cash flows. So even if the economy goes down, you can still rent your house, go move in with someone else until things get better, and you're protected with that. So, and the last thing I want you to think about is, if you're buying real estate as an asset, you want to always be buying real estate. So it's almost like dollar cost averaging. We talk about that when buying stocks. It's also the same thing when purchasing real estate. You're going to buy some real estate at slightly higher prices, and you're going to buy real estate at slightly lower prices. But if you just keep on buying real estate, you have a nice portfolio that, as long as it cash flows and you have some built-in equity at the time of purchase, you're going to make out just fine in the long term. So let me know what you think down in the comments. Are you looking to buy a house right now? Are you waiting for the market to crash? Hopefully this video is helpful to anyone. Remember, it's not financial advice. If you've made it this far already and have not already subscribed, please make sure to gently tap that subscribe button on the bottom right, or sorry, on the right side of your screen. You can also hit the notification bell right next to that, so YouTube notifies you every time I upload a video. And just destroy, as a lot of people like to say now, the like button, leave a comment below. And also make sure to follow me on Instagram. I'd love to get more followers, talk with people over there. I post there pretty much daily. I'll leave my handle right here. I've been talking to a couple YouTubers about wanting to collab. I'm totally down to collab. Let's get together, let's build more subscribers in our base. If anyone wants to collab, send me a direct message on Instagram. Again, my handle, I'll put it right here one more time. Thank you so much for watching, and I'll see you in my next one.